Yes, I am. Okay, so one of the things that, the main thing we want to accomplish today is help everyone as real estate property owners understand their common tax forms and deductions and, make sure they're utilizing every avenue they can to
Give me
leverage
one when you
their
get.
investment. Um, Anything from me is just you know, my experience, but I am not a professional accountant, and please do not take anything I say as expert tax advice. Trisha can be utilized for that. We have some questions that we compiled from RSVPs. There were a lot of questions submitted, which I really appreciate, but we plucked out a few that were a little less specific to individual situations, and we'll cover those at the end. But please, send in questions to the chat throughout, um, and if we
Yes,
can
like
answer things at the end, real time,
your
we can do
property,
that too.
12 months,
Uh,
income 12 months.
so
You see
a
it?
little bit about real property management. So our Richmond office is kind of the flagship office, but we also own and run the Real Property Management Summit office, which services Stanton and Harrisonburg, and then the Real Property Management Tidal, which is Newport News and Tidewater, Virginia Beach area. So, what we do is, you know, help our owners in these markets as well as try and, connect everyone so we can, better service, expand our client base into these new markets all across Virginia. And we are proudly opening a new branch in Petersburg. We're going to have a office warming party next month, and
Oh,
everyone's
and
invited down there
that's
for that
important
as
because
well.
there's something
That
I don't know where I read it. I thought I saw it in the
that
this
should
time it
be
was Zoom.
um, hopefully well attended. Trapezium
That's
Brewery is right next door, and we'll kind of have a March Madness and open door policy for anyone that wants to come down and see the new space. Um, when you are filing your taxes with an investment property, these are the main forms that you're going to encounter. So Schedule E, most folks with long-term rental that are utilizing their rental property for passive income will be filing with a Schedule E. Schedule C, itemizing your expenses and different deductions that you incur during the year with your investment property, and then S corps, which is mostly real estate professionals and just another way to, you know, again leverage your income surrounding your real estate investments. Um, to speak more about them is Trisha. So Trisha Rudolph is the owner of Professional Accounting and Computer Services. She's been doing this a long time. She's a friend of mine and has helped me on numerous things and numerous of our clients as well. Trisha, if you want to just kind of talk a little bit about yourself and the business, and then we can kind of get into these forms that folks will be seeing.
Like I said, I'm a full service accounting firm. We do individual tax returns, business, real estate tax returns, nonprofit. We do payroll processing, financial statement prep, just business license, personal property tax, sales tax, pretty much anything accounting firm would do.
Great.
So I'm going to go over some of the differences of some of these forms and who needs to file what. So most of you are going to file a Schedule E. So who would file a Schedule E is somebody that has a passive investment. And what a passive investment is someone that doesn't work in the business or so like if you rent an apartment, you rent it one time, yeah, you collect the rents and you pay the expenses, but you're not working in the business. So that is a passive investment. So it's good for long-term rentals like apartment or something like that. You do basic landlord services such as you maybe pay for the trash, maybe pay for water or supply trash removal. And it's not subject to self-employment tax, which is a big thing because self-employment tax can get really expensive. So, you can still deduct the normal expenses, which we're going to go over later. So that's most of y'all probably fall into this category. So then the next step is the Schedule C. So an example of a Schedule C would be somebody like that has a short-term rental, such as a bed and breakfast. So they're actively in that trade or business because they're supplying meals, they're supplying sometimes daily cleaning. So they're actively involved in the business. So that is a trade or business, and that is subject to self-employment tax. And so that's the main difference is that with a Schedule C and a Schedule E, Schedule C, you have to pay self-employment tax. Schedule E, you do not. And Schedule C is for an active trade or business. Schedule E is not. So S Corp. Normally, residential people do not file as S Corp, but if you have 20 rental properties and you're actively involved, then that you might want to look at becoming an S Corp because you're going to have a lot of income, hopefully, and you don't want to pay self-employment tax on all that income. So at some point you might want to look and become an S Corp. So an S Corp requires a separate tax return. You get a K-1 issued, and that's reported on your personal tax return. So you pay the tax on your personal, but you do have to file a separate tax return. There are also some other issues with S Corp where officers have to have payroll. And it's still reported on Schedule E on your personal return, but it's reported on Part E from the K-1. And like I said, this is less common for typical residential investors.
So, Trisha, when, if your day job is, managing a tech company, but then you have a duplex on the side, that person whose passive income from their investment property will be just filing the Schedule E. That's correct?
Correct.
And then if you are hands-on managing and overseeing your short-term rental and you're in there cleaning between tenants on the weekends and things like that, that would be filed with a Schedule C because you're directly involved.
Well, yes, you have to be directly involved, and you have to be providing more services, like I said, cleaning, and not just cleaning, because in the long-term rental you could be buying cleaning, but it would be things like
The booking,
supplying the meals,
okay.
cleaning daily, not just when they leave. It's a more substantial service.
Okay.
Like,
but with all of these, the deductions are going to be similar. What are your main highlights of deductions that people oversee or overlook, and make sure that you're exploiting as best you can?
well, a lot of people interpret between repairs and improvements. So improvements have to be depreciated, but you can take something called Section 179, so you can write it off, and versus a repair, which repair, if it's an improvement, you can't do. Another thing is mileage. You can take mileage from your home to the location if you're going there to repair it or to check on it. So you can deduct the mileage for that. You can deduct, if you're filing a Schedule C, or I think with a Schedule E, you can deduct legal and professional fees.
Property management.
Yes, property management fees too. And also you can deduct mortgage interest. You can't deduct the principal, but you can deduct the interest. And there's a lot of things, insurance, real estate, and insurance,
The
advertising cost.
So the improvements, we refer to them as capital expenditure a lot in my world, or CapEx, where you're improving the condition of the property to make sure you're at top of market for rental value. So what you're saying is on a capital expenditure, that total cost is higher than a repair. You spend $20,000 on a renovation, and that can be kind of broken down over the course of a few years rather than all at once.
Yes, so I mean, the IRS rule is it has to be. So if you don't do it, you get audited, they're going to make you go back and do it.
Okay.
But the yes, it has to be depreciated, and um, it's because it's increasing the value of the home, and it has to be something that you can't take with you. So like if you put a refrigerator in your home, that still can be depreciated, but it's a different type of depreciation than improvement. Um, Improvement is a longer term of depreciation, like where like a refrigerator is like 7 years. Um,
Okay.
so there are a lot of things, most anything that you put in there to improve it can either be expensed or depreciated. And like I said, even in depreciation, even though you put it in that first year, if you have enough income, there's something called Section 179 depreciation, which means even though you depreciate, you can still write it off all in that same year if you have enough income.
The a lot of the service and time around these investment properties is absorbed by us as the management company. But obviously, these property owners are reviewing, expense statements and, encountering with us, like, what's the availability to expense internet and, office usage of their home and things like that. Is that an itemized item, like something that would be able to be filed on a Schedule E, or is that more so, going to be for Schedule C exclusively?
That Schedule C, well, there is Schedule C is where you would file the home office deduction. I don't, well, yeah, anyway, that's where you would file that. You can also, there's things you can do with an S corp. You don't file a home uses of your home, but you kind of pay rent towards yourself for the use of the home. Um, so there's ways to get around that. The same thing, I
Okay.
guess.
Yeah, yeah. Well, to assist with it, real property management. So what we supply all of our owners each month is an owner statement. So the owner statement shows all of the rent in, management fee collected, maintenance expenses, if any. If you have multiple properties, they're broken down by individual properties, so you'll have those reports to review, as well as cash flow statement with all the management fees. And then we send you your 1099, which I was talking about a little bit before. Everyone should have received their 1099 already for their tax filing. But along with those items, we can pull most any report. So if you're working with Trisha for your tax filing, or if you have a CPA that does your taxes right now and you need additional forms, they want to break down, more details of the expenses from your investment property, we can pull, almost infinite reports surrounding the property of, just expenses related to inspections, capital expenditure. Like I said before, we can tag, different maintenance as, different usage, and, just make sure that you're leveraging, every aspect of the rental property, that you can, and we, want to provide that information for you, to do it well. So a couple of questions, and Trisha, I'm going to lean on you a little bit for some of these for sure, but that were submitted with the RCP. So number one, what is a common mistake to avoid when filing taxes with a rental property? Something that is typically overlooked if someone's trying to do it on turbotax.com or something like that.
You're asking me. Okay, well, I already mentioned the two. One was mixing business, well, one was mixing business and personal finances. So I would always have a separate checking account for those. The other is missing depreciation deductions, like which I just said, incorrect recording of repairs and improvements.
Mm-hmm.
Those are some of the biggest mistakes that I see. Um, and
Yeah, I
that
like the idea of a separate account. I'll recommend that a lot, for new clients that are coming on. If you have a buffer of 2 months of, mortgage payments in that account, and then your rents are being received in there, you're paying mortgage from that account, you're paying expenses from that account. It's a lot cleaner at the end of the year to review and see, what your expenses were, what your payments out were, things like that. So that's a good point with the separate bank account, just to divide it all, making your life a little easier in the spring for taxes. Um, I actually saw Trisha this morning and brought this one up. So how will you be impacted if you move states in the middle of the year with your investment property filings?
Don't do it. I'm just kidding. No, you will have a part year return in both states. Well, depending when you move, I guess. So say you moved in June, you're gonna have a part year in state one and a part year in state two. So yeah, it's a little more complicated for your tax filer, but it can be done.
And then that's
Your federal does
surrounding
change.
that
Sorry.
rental income that you make once you've moved to a new state. Um, that all counts towards. So Alberta's in Arizona. She doesn't live there, I know, but you go to Arizona, all of the rental income that you make for July through December, that is, income through Arizona, even though the property itself is in Virginia.
No.
No.
So you're okay. So you're saying that you have a property in Arizona and you're renting it in Arizona.
No.
No, no.
If
What
I
I'm saying is if I have my rental property in Virginia and I move to Arizona, my rental property stays in Virginia. And
And it's a Virginia return. It goes on a Virginia return.
okay, it all goes on the Virginia return. Okay. Um, so this one this third question can get a little broad. And so I want to just kind of hone it in. So how does selling your rental property impact your taxes? Trisha, could you just speak a
Sure.
little bit about one, capital gains on selling your rental property, and then two, the 1031 exchange of, utilizing that.
Okay, well, of course, it depends if you have a gain or loss. We're going to assume you have a gain. So
Mhm.
if you have a gain and uh, you can have if it's okay, if you sell it for more than you own it for more than a year, you have a long-term capital gain. And those capital gains rates can be 0, 15, or 20%, depending on income, depending on your tax status. So those, and usually your capital gains are taxed at that rate and your whole return can be taxed at that rate. So if it's a short-term rate, then it's at the higher ordinary, it's taxed the higher ordinary tax rates, which again depends on your tax status of your overall tax return. The 1031 exchange, it's a way of deferring the capital gains by using the 1031 exchange to reinvest into a similar investment property, similar to buying a home, where you buy a home and you put your gain into another home so that you don't have to
Pay
get
tax on
that,
that.
pay tax on it. So the 1031 exchange is very similar to that. So you can do a 1031 exchange to avoid to a similar investment property to avoid that capital gain.
Yeah. Yeah, the 1031 exchange, if you haven't lived in the property for 2 out of the last 5 years, and where you would be exempt to a certain degree on some capital gains if you were just trying to sell and not necessarily go buy something else, or like Trisha said, sell your primary residence and move into another primary residence. It's a good way to take all of that gain and then hold it in equity in a future purchase. There a pretty decent amount of parameters around that. But if anyone's interested to sell one property to maybe go buy two properties or something like that, take all of that gain and push it between two instead of just the one. Something we can help with as well. So those are the questions that we kind of pulled from the RSVP. There's nothing in the chat. Does anyone that's on have anything top of mind that they wanted to pose as a question for myself or Trisha? Okay, so here's one. If you sell your investment property and you have gains on that, I guess in this situation, you would be selling your current primary residence and then selling your investment property at the same time. Could you take the gain from both your primary sale and your investment property sale and push those all into your next primary purchase and avoid capital gains on the investment property sale. Does that make sense?
I don't think so. I think the primary has its own rules where you can get an exclusion up to a certain amount, and then you don't even have to take it, even if you don't invest it in another property. And the investment property has its own set of rules.
Okay, so there,
Don't
it's
think you combine the two. I would have to double check on that because I've never had that question asked. But
I think that they would probably remain separate. Like you said, they have their own sets of rules, and to commingle the proceeds from the two, I don't think it would probably be a challenge to get those to waive any taxes. So here's one, replacing a bad roof, an improvement or a repair. Trisha, correct me if I'm wrong, but I believe that is a repair, to replace the roof, which, would be an expense incurred for that calendar year and that tax year, but would not be, depreciated over years to come.
yeah, I'm pretty sure you're right. A roof is repair. Checking now.
And then we'll do this one last one. If someone owns a rental property here in Virginia and they live in another state, and at no point do they live in the state of Virginia, would they file their taxes for the rental property in Virginia, or would they file those taxes for the state they live in?
They should file a Virginia return because the Virginia is going to want the taxes for the money you made for the Virginia property.
Okay. And reach out to Trisha as well. I don't want to get into a bunch of super specific, but she's,
Okay.
She is definitely more than capable to, assist with these tax filings, not just for people that live in Virginia, but across the country, and can get, all these specifics nailed down. Alberta,
Okay.
yeah, that 1031, you have a limited time. We can, so if you sell an investment property and you want to utilize 1031 exchange, you have 90 days, 90 or 100 days, I think, to close on your next investment property. So that times, there's a lot of parameters to that, but if anyone's interested in the 1031 program, just reach out to me. I know a little bit about it. But yeah, that's good for now. I want to kind of button this up here before 11:30 and get everybody out. I appreciate everyone's time and coming in here. So, one of the things that we're trying to provide, besides excellent property management service for all of our owner clients, is educational opportunities like this with professionals that we work with in the industry, like Trisha. So this will be kind of the first installment of quarterly, educational opportunities for our owner clients. And if you have ideas for ones in the future, we've got something kind of slated up for Q2. And just want to, make sure everyone's getting the most out of their properties, not just collecting the rent and performing maintenance. So I appreciate everybody's time. And Trisha, I want to thank you again for hopping on here. I'll follow up with everyone and have all of my contact information and Trisha's. Any additional questions, just send them over. And then, if you need help with your tax filings for 2025, Trisha's your girl. So, all right.
Thank
Well,
you.
I appreciate everybody. Trisha, thank you again.
Thank you. Thank you, everyone.
I hope you guys all have a great Tuesday.
And I put a comment about the roof in the thing.
Oh, yeah. Okay. Yeah, roof replacement is a capital improvement. Fixing a leak is a repair. All right, that's good. That's good info.
Hey, thanks,
all right.
Mark. I'm gonna
Yeah.
call you about property.
Yes, please do. All
All
right.
right, thanks.
Thank you.
Thanks, everyone. Bye.